Thank you very much, Lucette. Let me jump through the very important disclaimer slide. And first of all, position credit multi-factor investing. As was mentioned at the beginning, factor investing is very well present in the equity space, but also in the commodities, FX, and the rate space. However, credit remains the final frontier, and just a quick explanation why that's the case. On the equity side, in all of these markets, we have very simple single instruments. As you would have heard from any fixed income investor, equity is much simpler compared to fixed income. One stock describes one company. These instruments are very liquid. You do have derivatives on these instruments. It's very easy to transact. Most of the transactions take place electronically, so you do have quite a lot of data available. First of all, obviously, because the companies are public, but also because your trading is very transparent. You can construct strategies using quantitative signals, and people have been doing it for a very long time. Indeed, as early as 1930s, there were papers published on value investing. And we obviously saw a rise in interest for factor investing after the paper of Hanmer in French. Therefore, you can currently access this strategy through a number of different vehicles. You can buy mutual funds that will have certain factor tails. Actually, if you look even on platforms, when you want to select your funds, you will probably all know that you can see metrics of what factor tails you will see in the portfolio. You can invest into single factor and multi-factor ETFs, and obviously hedge funds will be quite heavily using factor approaches. All of that is true for equity, commodities, and rates. However, credit is still the last bastion of active investment and pure passive investments. And at this stage, I also would want to explain to you how we really position the credit multi-factor strategy that we'll be presenting today. It stands somewhere between a pure passive approach, where the investment manager will be trying to replicate the beta of an index, will replicate the performance of the index minus the cost, without trying to change any of the locations within the fund. On the other end of the scale, we do have active managers, which are aiming to generate alpha through security selection, but also by changing a lot of the beta allocations. So you will have obviously allocations to duration strategies. Portfolio manager and active portfolio manager can change the credit beta of the portfolio by going short and long DTS. They can allocate to different sectors depending on their views, and they can also allocate to different regions depending underweight and overweight regions depending on their views. The strategy that we are presenting today is aiming to generate alpha, but this alpha is generated primarily or only through security and issuer selection. So we're trying to identify the right bonds from the right issuers, while at the same time keeping all of the other macro level constraints in line with the index. So what you basically will see is that the portfolio that we construct will have the same allocation to rating buckets, regions, sectors as the index, but at the same time we will be taking idiosyncratic risks to identify better performing issuers and specific bonds. As we mentioned at the beginning, this is also about sustainability. So also one of the factors that will be changing is the overall sustainability of the portfolio. Now I will hand over to Joe Hanmer, who will much more in detail explain how the factor is actually constructed and what are the difficulties that we faced when we were preparing this strategy. Over to you, Joe.
Thank you very much, Ilia. And hello, everyone. Thanks for joining today. So, yeah, as Ilia said, we've been doing this research now, probably focusing on multifactor for 4 or 5 years, and it's built on a lot of the historic work we've done within fixed income at Fidelity, where we've got a very long track record of developing quant research and models for the discretionary process. And what we did when we set about that research is start to think through the key problems that there are with factor investing in credit and in fixed income compared to equity, like Ilia has just walked through it. And you can see those on the left-hand side. So unlike equities, it's very hard to short in fixed income. So the cost and the ability to source corporate bonds to enter short positions are very punitive. So it's really difficult to implement a more traditional long-short factor type based approach that you might see in the equity world. It's also liquidity and transaction costs are much more important in the credit markets. The market is much more over the counter, it's harder to trade, it's less liquid and more expensive to have the higher turnover that's usually associated with more systematic factor-based strategies. We also don't have as much data as they have available in the equity world. And that links very closely with the under-researched element, because in corporate bond markets really have only been around for the past 20, 25 years, and we only have good quality data available since the early to mid 2000s. That's really important for the sort of testing and discovery of factors within fixed income. And that's been one of the real drivers as to why we've seen a lot of research from academic and practitioners in the equity space and possibly in other macro type spaces where data is much easier to get hold of than we have in fixed income, where it's both harder to get hold of the data and the history you have available is much shorter. So the significance of any results you look at are obviously going to be lower. And finally, there's the complexity. So, you know, as Ilia mentioned briefly, in equities, you have that simple single instrument that represents a company. And you cannot be either over or underweight or long or short that company to express very easily your view on a given company based on some underlying factor scores. In fixed income, it's much more complex, and there's a lot more decisions that you have to make when deciding how to express that view. So within a given company, you might have tens or even hundreds of different bonds to choose from. All of those bonds have different features in terms of seniority, duration. They have different language in the documents, which makes them trade at different levels. And there's also different currencies around within a given issuer as well. So simplifying that complex structure into a way that you can think about factors in fixed income is kind of one of the key elements we thought about when starting the research. And so I'll start off with just touching on how we think about and simplify that problem. And the way we go about solving that is, rather than thinking about translating an equity style approach directly onto individual bonds, is we split the problem into two levels. So firstly, we think about the issuer level of a company. So that's a company by company basis, thinking about what factors drive the returns of a company's bonds. And to do that, we spent a lot of time over the years developing our proprietary credit curves within Fidelity. And these curves allow us a way to generate a sort of synthetic representation of what an issuer exposure would look like. So this isn't thinking about exactly which bonds to buy and which bonds are cheapest, but it gives us a representation of what an issuer looks like. And this makes the problem a lot similar to the equity world, i.e. we have one representation of an issuer that we can use from fixed income, similarly to the one company and the one equity we have on the equity side. And that really allows us both to leverage the history of research and techniques from the equity landscape in terms of how they look at and assess factors, and we can use that in the fixed income side. And it also simplifies the problem a lot in fixed income when it comes to those complex instruments. But what it does mean is that because we've simplified that and our factor view is only on an issuer level, not on the individual bonds, that we do need a separate problem to solve, which is once we've decided on those companies that we want to invest in at the issuer level, we then separately need to think about which bonds of those issuers we're going to purchase and how we're going to decide which of those bonds go into our portfolio. And so we'll talk through those two steps of the process, the issuer and the bond selection separately, and then we'll talk through how we bring those two steps together into a final portfolio. And so here we can look at those key elements and how that factor construction process works. So here we're talking about that first step. So we're really thinking about, we have a range of companies within fixed income. How do we decide what a successful factor looks like in fixed income, and how do we bring those together? And the way we approached this was thinking about the key sources of information that we could use to drive factor exposures. The first, which is kind of the most obvious, is there's been a lot of research, there's been a lot of publications on the equity side of things. And because we've simplified our fixed income problem to look very similar to the equity problem, we can very easily take those equity factors and equity definitions that have been well researched and shown to work in the equity landscape and simply translate them and test them out on our fixed income data set on our new problem at the issuer level. Secondly, we obviously have a lot of new different data that's very specific to fixed income that won't have been looked at or tested in the equity world, that we can create new factors from that have possibly not been explored previously because the research is focused in equities. So this might be things like leverage or specific valuation type factors, the shape of a curve, for example, which are all very fixed income orientated ideas that wouldn't necessarily apply to equities. Whereas those equity type traditional factors that many of you will have heard of are things like equity momentum, equity value, something like price to book or price earnings, dividend ratios, for example. These are all very common factors that people have looked at and had success in the equity world. And then we have a third bucket of potential sources of data, which is things that are more cross-asset in nature. So they're not specific to either a fixed income or an equity asset class. They are more generalized to the company as a whole. So something like sustainability is a great example here, because ESG type characteristics are at a company level. There's nothing fixed income or equity specific about that, the nature and the ESG nature of a company. There may be some elements within that are more specific to fixed income. Maybe governance is more important in fixed income than it is in equities, but in general, these values are more cross-asset in nature. And so then we go on to the next step. Okay, we've got these three different types of data we can look at. So we want to create some factors from that and see which of those factors are successful or not in our process. And to do that, we do that in a very automated, unbiased way. So we don't prescribe fixed factor definitions that are assigned to a given factor. We allow our selection mechanism to decide which factors of those different spaces work. And on the next slide, I'll show you some examples of how that goes. And that's data selection approach of factor selection is key to bring in the transaction cost considerations. As we touched on the previous slide, transaction costs and liquidity are much higher in the fixed income space. And so integrating those considerations into all the different steps of the process is key in making sure that the factors that you create are actually implementable and usable in practice, and don't just look good from a theoretical standpoint. And then once we've selected those factors, we need to blend the factors together to create what we call our Fidelity multi-factor score, which is our aggregate view on the companies that we feed into our portfolio construction mechanism. So on the next slide, I'll talk through a couple of examples and try and bring to life a little bit that factor construction process. So this sort of just shows you in a little bit more detail the same 4 steps that I've just talked through on the previous slide. And you'll see in blue on the left, we've got different examples of the factors that we've created from those 3 different types of data: the equity, fixed income, and sustainability cross-asset type of data. The middle step is the calculation of that, so converting that raw data to an actual signal that can be tested and we can see how it performs in the real world. And then we bucket those signals into, first of all, more granular buckets in the sort of pale orange, things like bucketing all spread related signals together or all equity related signals together. And then we group into our 3 core factors. So these are our 3 elements that we think drive corporate returns within fixed income. The first is sentiment. So this is what you might think of as momentum style indicators, but we're looking not just momentum, but we're looking cross asset class and at a variety of measures. You have the fundamental group, which is the quality type indicators or things driven by fundamental accounting data such as profitability and debt serviceability, which debt serviceability is a good example of a very fixed income specific factor. And we have value, and you know, I think it's obvious what value stands for. And these 3 buckets are then combined into our overall Fidelity credit factor. And to give some examples of those different buckets that we talked about, some things are very intuitive. So one thing you might think about if we think about the value bucket is, what does value mean in fixed income? And I touched on at the start, the first thing you can try is trying valuation metrics from the equity world. When you do that and you look at things like price earnings, price book, which are traditional value metrics from equities, you find that they have no value. They don't add any alpha from a fixed income perspective. And that's kind of what you would expect. They're very equity specific in their definition. There's no real fundamental reason why they would transfer and apply well into the fixed income world. But what we do find in that valuation bucket is that the fixed income specific factors, so things that we've for a long time looked at in fixed income, that we've for a long time produced and integrated into our discretionary portfolios as typical value measures in fixed income. So things like spread per leverage, like you see there, things like the shape of the curve within fixed income, steeper curves being a good sign of value, and you want to own those steeper curves and be underweight the more flatter curves within fixed income. Those metrics work very well, and a lot of those get selected and used in that value bucket. But on the other side of things, if we take the sentiment bucket as an example, we kind of found the opposite, in the fact that it looks like from our analysis that the equity type sentiment signals, so using momentum measured from the equity market, is a much better measure, and it moves quicker and reacts sooner and gives you a higher value signal than using momentum directly from the fixed income world. So these 2 examples highlight the benefit of looking at this on a very cross-asset nature and looking at a wide variety of data from across different asset classes and different areas and combining them together. To finish on an example from the last bucket, so from the sustainability bucket, we found that in sort of ESG data in the ESG world, like we've seen from other publications, that the momentum or the change in ESG is actually a very good signal and is a good potential factor to use within this sort of multi-factor framework. But what we also found is that the alpha from that ESG momentum was actually very similar to just the typical more simpler measure of equity momentum. And so when you combine those 2 in our automated selection part of the process, it actually prefers the simpler equity momentum and puts more weight on that within our sentiment bucket than it would do on an ESG type momentum measure, even though both are successful and add value. So if we go on to the next slide, we can just show a bit more of an illustrative example of how this works in practice. So this is an example of a company, Amgen. And if we start on the right here, you'll see the final credit factor score for this company, which is 1.27. That's a very positive score. So these scores range from +2 to -2. So +2 means we really like the company. We want to be overweight in our portfolio. -2 is the opposite. We want to be underweight that particular name. As you step back along that process, you'll see that we have our 3 main buckets that we talked about: sentiment, fundamental, and value, which each have a score which is aggregated into that credit factor. And you can see from the above pie chart, circle donut chart there, that it is not a simple equal weighting of those 3, that our selection algorithm has weighted those 3 buckets in favor of value. Value is the biggest driver and the most successful deliverer of alpha within these fixed income portfolios. And our process recognizes that and gives valuation a much higher weight than the other 2 buckets in that process. And the same process is applied as you would move back. Each of those 3 buckets is broken down into the subcategories. In this case, we've given the example of value, where we have things like spread per leverage, which I've mentioned, relative performance, which is a measure of equity performance versus fixed income. So if the fixed income issuer has massively outperformed what you would expect given the performance in the equities, then that's a negative sign. It means that there's too much enthusiasm in the fixed income markets, and that would result in a short position or a negative score from the relative performance. And as you can see from that same one, in this valuation bucket, things like spread per leverage gets a very high weight. That's a very fixed income specific measure, which really drives performance in fixed income, and it gets over half the weight driving into that bucket. So hopefully that gives a good intuition about how the selection process works, some of the ideas behind the factor process, and a bit of an example to bring it to life. So then we can look at how this actually performs. So what does this multi-factor score actually do when we look at an aggregate portfolio? And here we show the performance in a very typical equity factor sense. And you know, the reason we can do this is because we've simplified and split the problem into 2 to make it similar to the equity world. And what you'd very often see in an equity world around factors is we split the equity universe into quintiles or deciles, and we track the performance of that factor through time. So on the left, you can see if we split our factor score, the light blue at the top tracks the performance of the 20% of companies which have the best and most positive factor score through time. And the dark blue line on the bottom, the 5th quintile, shows the performance of the worst 20%. So those companies that have the lowest factor score from our methodology. And as you can see, there's a big amount of dispersion in 2008, 2009 during the crisis, as you would expect. Volatility and dispersion was very high. And then after that, you'll see a slowly positive accretion of value from the top 20%. It's in the same order as you go down the quintiles, and similarly a slowly losing money from that bottom 20%. And on the right, we show the difference between that top and bottom quintile, and you can see that is producing a steady stream of alpha through time. And one thing that's interesting, and is sort of a feature of the fixed income markets that you might not see in the equity world, is that the 5th quintile, you'll see the negative performance from the 5th quintile is larger than the positive performance from the 1st quintile. So, you know, returns in fixed income are very asymmetric. So avoiding the downside, avoiding those blow-ups and being underweight the companies that either get downgraded or get into trouble can add you a lot more alpha than picking the best names in the market. That's just the nature of fixed income, and you can see our credit factor is doing a very good job of that. It's making a lot of money from avoiding the downside and reducing the drawdown, avoiding those blowups, and it's making positive but less money from picking the best names and owning those companies that outperform through time. So that shows you how our credit factor is created, how it performs, and how it adds alpha through the cycle. We then, as we mentioned at the very start, we've split the problem into 2. So we then have to think about, okay, that factor score is going to show us how we choose which companies we want to own in our portfolio. And we're going to be overweight the ones which have a very positive score and underweight the ones which have a very negative score. We then need some way to decide within those companies that we want to own in our portfolio, which specific bonds are we going to buy, and how are we going to decide that? And there's 3 key elements that drive that decision process. The first 2 of them are 2 value type metrics, which you can see here on the slide. And the third, which is not on the slide but is equally as important, is the transaction cost and liquidity of the individual bonds. So on that first aspect, we're looking at value, and the 2 measures that we look at on value can be seen here. So the first is roll down. So roll down is a measure of how much you can earn from owning a bond if you just buy the bond, own it, and nothing changes. Naturally, curves, like the curve you can see on the right-hand side in fixed income, are upward sloping. So if you buy a bond that is 5 years of duration, in 1 year's time, that bond will have 4 years of duration. And due to the fact that that bond will have rolled down the curve, we call it, will have reduced in spread, that will give you a positive return. And so on the left, we just plot a measure of what that positive return would be versus the duration of the bond. And when we're selecting bonds in that portfolio, we're going to prefer bonds with a higher roll down, a higher metric. So in this chart, the ones highlighted in that light grey area are going to be preferred to the bonds at the bottom of the chart. So that's one metric. And then our second metric is what we call our bond residual. So the roll down is an outright measure of cheapness, but this residual is a relative measure of cheapness relative to the other bonds of the same company. So in this illustration here, we've shown all these orange dots are different bonds of the same company. And we plot the spread, so how cheap or rich each bond is versus the duration. And the blue line is an example of one of our proprietary curves that we fit to each issuer and each currency of that issuer, which shows where those bonds should trade from a sort of fair value perspective. And we can then use that curve to see which bonds are trading cheap and which bonds are trading expensive. So the cheap ones will be trading above the line, will be getting a higher spread than you would expect for those bonds, and the more expensive ones are trading below the curve. You're getting a lower spread than you would expect given the duration of those bonds. And so these two metrics combined give us a valuation view on each individual bond of a company. So a company scores well, so let's say we've got a company that scores 2 on our Fidelity credit factor and has 15 different bonds to choose from. We're going to tend to use the bonds from those 15 that have a high roll down and are cheap on our residual measure. But the key caveat to that, as I mentioned at the start of this slide, is the transaction cost. So even if a bond has a very high roll down, it looks very cheap to the curve, but from our transaction cost modeling, we know is going to be very expensive to trade and not very liquid, that transaction cost element will counteract the cheapness and the valuation of that bond, and the bond won't be selected. So the aggregate selection measure on the bond basis is therefore looking at the combination of value versus transaction cost across the bonds with that issuer to select what we think is the most optimum combination of bonds to take that exposure. And so what we can then look at is, okay, we've got the idea of which issuers we want to own. We know how we're going to select those bonds in the portfolio. How does it all come together? And I'll touch on the left-hand side and then hand back over to Ilia to give a bit of an idea of how that comes to life in practice. So on the left-hand side really shows you those key inputs that I've walked through and how they get combined. So we have that Fidelity credit factor, our 2 bond value factors, and the penalization for transaction costs. All these go into our objective function of an optimizer that we have built in-house within our Optimus software, and that optimizer creates the portfolio. But what we have to do on top of that optimization is make sure that we are applying a range of style and risk constraints to make sure that the exposures that we're generating from our portfolio are exactly what we want to achieve. And what we want to achieve is tracking error relative to the benchmark that is purely associated with selecting the right companies and selecting the right bonds. So we purely want credit and bond selection within our portfolio, which means that we want to very closely control for the macro type factors which might otherwise affect the performance of the portfolio relative to the benchmark. So things like the aggregate beta or market exposure of the portfolio, the duration, the sector and regional exposure, the currency exposure. All these are controlled very closely with the style and risk constraints to try and give us our overall portfolio. And with that, I'll hand back over to Ilia.
Thank you very much, Joe. Just to elaborate on what Joe just explained about on the portfolio construction side, basically to ensure that the beta of the portfolio is closely aligned to the beta of the index that we are aiming to outperform. We create a very tight risk budgeting framework, whereby we break down the risk in a credit portfolio into four main subcategories. It's credit risk, duration, curve, and currencies. When we look at specific credit, we will be looking at it in terms of weights. And hereby, well, what I mean by credit is, for example, exposure to different rating buckets, exposure to different sectors, regions, and so on. And we look at it in terms of weight, but we also look at it in terms of DTS. And at this step, we'll basically be creating risk budgets that allows us to take a very controlled level of risk in a specific issuer and in specific bonds. So we're allowing for an overweight to issuers and bonds, but we are trying to keep the allocation to sectors, regions, and ratings as closely aligned to the index as possible. In the second step, we're looking at duration, and hereby we're looking at duration again on the overall portfolio level. But we also, if we speak, for example, about the global portfolio, we'll be breaking down the duration to duration by currency, so that basically every currency or every region in this case will be contributing the same amount of duration as the index. And similarly, we do it also for key rate duration and for currency. So we really try to build a risk framework that allows us to take idiosyncratic risk, to overweight issuers and bonds, in order to create an improved exposure to credit factor. But at the same time, we keep keeping all of the other constraints very tight against the index, so that the macro exposures, what we call them, are pretty much matched against the index. What we achieve is a very well diversified portfolio that is directly implementable, because we are taking into account transaction cost when we construct this portfolio. So it's not just an exercise for academic research. It's really about managing these portfolios. So the bonds we want to select, we also will have to be able to buy. We are looking at sustainability, and I will speak on the following slides how we improve on sustainability within the portfolio. But at the same time, if you look at this portfolio from a top-down level, it basically looks pretty much as your standard index. So we spoke a lot about improving the performance. We spoke a lot about how we construct the portfolio and the actual factors, but we also promised to speak about sustainability. Joe touched on it a little bit in his explanation of how the credit factor on the issuer level is constructed. And we actually look at sustainability from two perspectives. First of all is, can we integrate sustainability factors into our credit factor construction? And secondly, how can we improve the overall sustainability characteristics of our portfolio? First of all, as Joe mentioned, within the credit construction itself, we looked at different definitions of sustainability. We looked purely at ESG ratings. So basically, if I buy a higher rated company in terms of sustainability, does it add to my performance? And we also looked at, as Joe mentioned, at momentum of ESG. So basically, if a company is rated low but increases its rating from year to year, does that add to performance? The answer to this question is yes. In those cases, we can see that, for example, if we speak about the absolute rating, there are periods of time where companies with higher ratings have performed better than companies with lower ratings. So, for example, as you see on this chart, between 2014 and 2016, where we've seen a significant increase in interest across institutional investors in sustainability, ESG, high-rated ESG bonds have outperformed. Similarly, last year, where we've seen quite a significant increase in demand for sustainable solutions, we've seen again high-rated bonds and issuers outperforming. But the signal itself is not very stable, so we cannot say that over the overall period it actually contributes positively to the performance. And as Joe mentioned before, on the momentum side, while it's a much stronger signal, actually we do have better momentum signals that the optimizer tend to select when constructing our credit factor. So in the end, actually the optimizer decides to select other factors than sustainability. So we decided that we need to treat sustainability not just as a performance driver, but actually as a standalone objective of our portfolios. And this is basically where where the portfolio construction and risk budgeting comes into play once again. So we do introduce portfolio sustainability aims as a standalone objectives, where we say that our portfolios, for example, this is an example of portfolios we're running currently and the risk budget that we have there. The portfolio needs to be invested into BBB rated bonds by MSCI at least, so we don't have any allocation to bonds below that, and 70% is better than BBB. We don't invest anything in single B and triple Cs. We have to tilt towards higher rated buckets. So for example, we're tilting more towards AAA, AA, single A buckets. And we're also screening it out for additional controversies. Additionally, we look at climate change as an additional, let's call it a filter within our risk budgeting framework. So we're trying to improve on the carbon footprint of our portfolios, whereby we lower our carbon emissions against the benchmark. Next to it, we also do have our sustainable fund family rules, which are much more exclusion driven. So we look at business activities, and to start with, we exclude all of the companies from our universe that are involved into production of cluster munition and landmines, weapons in general, tobacco companies, so companies that are actually producing tobacco, but also companies that have significant revenues from selling tobacco products, and also companies that are involved in thermal coal. Additionally, and that's again nothing specific special here, we're also excluding any violators of UN Global Compact norms. So this is basically what builds our sustainability framework. So while we think that companies with higher ESG standards going forward and over a longer term will definitely be the ones that will be contributing to performance, we also want to introduce sustainability as a standalone objective. So it's not just all about performance, it's also about actually improving the sustainability characteristics of the portfolio in their own right. And what we achieve, and I think Joe showed before a slide where we looked at the performance of the actual credit factor on the issuer level. Here we look at the overall backtest for the strategy. So here we're looking specifically for a global corporate bond backtest. And we're also showing here our out of sample performance. So it's a performance of paper portfolio, and for following, it's the performance of the actual portfolio that we are managing. So what you see here is that basically the portfolio in most of the years is generating positive performance. I think it's also quite reassuring to us that it shows negative performance, for example, in 2016 and beginning of this year, because we are looking at a portfolio that is creating alpha from security selection. We obviously need some sort of dispersion in the market in order to be generating the alpha that we are aiming to generate. So when the markets are very tight and when the markets do not really discriminate between issuers, so for example, when we have central banks heavily purchasing bonds in the market without any separation between good companies and bad companies, obviously it's going to be quite difficult to generate additional alpha. However, what is quite positive, we see here the numbers up until March 21. But actually, if we look at the numbers year to date, we are generating about 36 basis points of performance in our portfolio that is live and in the fund that is live right now. which obviously reassures us once again, because we do see some level of volatility in the market, and that helps us to generate performance. As I said, we currently, so it's not just an academic exercise. We've been integrating this strategy since in live portfolio since 2019. We're currently managing about $1.7 billion across US IG, Euro IG, and global IG strategies. The model also works very well in US high yield markets. So it's the model itself is calibrated for a number of different markets. I think it's also quite important to mention that the actual research on the back of it, so the factor research, works in any market. So it helps us also to supplement our fundamental research that we receive from our fundamental credit research analysts in other markets to basically have a better coverage in markets where we potentially are not yet that established. This brings us to the end of our presentation. I hope that it at least raised a lot of questions and interest. So here I would want to hand over back to Lucette to handle the Q&A.
Thank you very much. Thank you very much, Ilia and Joe, for presenting a thorough description of Fidelity multifactor model. Any question on the line, please? Any question? Perhaps if I get to ask the first question myself, maybe Joe, you can describe why is it so important compared to other models to segregate, obviously, which company we're going to invest in compared to the choice of instrument. Maybe something you want to elaborate on?
Yeah, sure, Lucette. I think there's a few key benefits that it brings us in when we actually look at the research that we're doing. One thing it does is makes the problem more similar to equity research, which means that a lot of the techniques and a lot of the ideas that have come from 30 years of academic research can be applied to the fixed income market, which wouldn't be the case otherwise. Secondly, it reduces the scale of the problem. So if you look at an instrument level, so let's take US investment grade as an example, there are around 11,000 bonds in the US investment grade index, whereas there are only around 1,000 companies, individual issuers. So it means that when you're like thinking about factor creation and backtesting, you're reducing the complexity of your problem from sort of the 10,000 scale to 1,000 scale. So that again gives you a lot of benefits from the data and slightly simplifying the problem. On the other side, it does add more, a bit more complexity and estimation and expertise required around the research, because the issuers that you're looking at, you can't buy exposure to issuers, right? That's why we have the second step, thinking about individual bonds and which bonds you choose. So we need some way of representing what an issuer looks like. And you could just, there's two sort of approaches to that. One just takes all the bonds and averages those bonds together, or market weights those bonds together to get a representation. And the other is our method that we choose, which is using our curves and taking a point from that curve through time. And one of the key benefits, we think, to our approach is that it gives you something very consistent and comparable. So we can take an exact same duration point and we can follow that consistently through time for each issuer, which means we get something similar to kind of like a CDS time series, where in credit default swaps, you can take a 5-year swap. Every company that has a swap available has the same tenor, it's the same duration, so you can compare those across all the companies very easily without having to do any adjustments or changes or manipulation of the underlying data. And that's the same situation we end up with using our curves. We can take a constant duration, the same point through time for every point in time and for every company, which gives us that simple comparison of what each company looks like through time, which can help us, which drives the creation of our factors and the selection of the factors in terms of which factors are best predicting that return and change of our 5-year point for each company.
Excellent, excellent. Any question on the line? Follow-up question? Don't be shy.
Hi, Lucette. I know we've talked a little bit about incorporating ESG factors into the multi-factor model. When you've sort of looked at the strategy historically, have you done any analysis looking at the difference in alpha and outcome, incorporating versus not incorporating it?
Joe?
Yeah, happy to say that one. Yeah, so it's something we've spent quite a lot of time looking at because, like Ilia touched on, there are numerous different ways you can integrate ESG into a fixed income portfolio like this. It can come in at the factor creation and can try and be a driver of alpha, and we've kind of touched on that and the different ways you can think about ESG and whether or not it adds value from an alpha perspective. Or you can think of it at the portfolio construction step, which is kind of the key element, the way we thought about it. Ilia talked through thinking about integrating at the portfolio level, how we overlay our proprietary ratings and think about the different sustainability aims and aggregate portfolio positioning in terms of having enough of the portfolio with certain ESG ratings. And so when you're doing that portfolio level, obviously, the first thing you look at is the sensitivity of your portfolio and of your model to those changes. So it's very easy for us to look at, say, we take a minimum, the example here on screen of a minimum 70% of the portfolio rated BBB. We can obviously have a look and we can test that rate, move that from 0 to 100% and see how it affects the portfolio. And what we find is that it's actually very similar when you look at ESG versus looking at any other way of really excluding names from our benchmark when it comes to its impact on the alpha generated. And that's because the real driver is not necessarily the fact that it's ESG itself, it's the fact that you're reducing the universe available to the underlying model. And the smaller you make your universe, the less diversification you've got and the less ability the model has to make good decisions and take advantage of the breadth of companies available. But what we do see is actually, the model we use and the multi-factor scores we have is, although it's very linear and it's in the direction, the less companies you have available, the lower the returns will be. The sensitivity is quite low. So you really have to move quite far and exclude a lot of the universe before you start to see a significant impact on the performance. But then what you will see is when you get to a very extreme, let's say you excluded 90-95% of the portfolio, you will see that that alpha and return potential drops off because you've just got so few names to deal with. But you can quite easily remove 50, 60, even 70% of the portfolio and have quite a low or very marginal impact on the returns you would expect. And you could do that. That could be filtering by ESG. It could also be filtering by sort of sectors, or it could be removing any elements of a portfolio you want, as long as you're not reducing the breadth available to a too wider extent. You don't find that it's really damaging the alpha potential.
Okay, maybe we've got a question on the line. In terms of multi-factor, obviously here Fidelity has adjusted the model to establish credit strategy, but do you think it will work for other asset classes? Maybe a question for Ilia?
Thank you. Yes, definitely. So as I mentioned earlier on the call, the strategy does work across a number of asset classes. So here we're looking at investment grade, but similarly, it works relatively well in high yield. In high yield, obviously, we need to think about liquidity significantly more than in the investment grade space. So while we can generate a very attractive level of alpha in the high yield space, which is in excess of the alpha we can generate pre-transaction cost in investment grade. Post-transaction cost, the alpha between IG and high yield is pretty much the same, just because the transaction cost in high yield are so much higher. It can also, and we are currently extending the model to emerging markets sovereign specifically. So the drivers and specific signals that we will be using, as Joe presented before, will be slightly different for sovereigns for quite obvious reasons. But the model itself is pretty much similar, and we will be working in a very similar way. So we'll still be looking at fundamental quality of a sovereign, momentum strategies, circulation strategies, and again, we'll still be dividing between issuers and bonds. So yes, it might have to be adjusted to address other asset classes, but the model works pretty well across numerous asset classes in fixed income.
Yeah, I see that, you know, the question also touches a bit on private companies, which is another interesting, you know, aspect of the model, because especially, you know, in a big developed fixed income market like US investment grade, there's a very high proportion of the market which is as a listed company. Whereas as you move to different markets, whether that be something like European high yield, Asia high yield, these different areas, the proportion of the bond index that has a listed counterpart becomes much lower. So it might be like 80 or 90% in US investment grade, but can be below 50% in some other markets. So, you know, knowing that, we made sure, and in the model construction and selection process, it's very flexible in the way that it's set up, such that it has ways to compensate for the fact that some companies will have far fewer factors than others. So if it's a private company, we're obviously not going to have the equity data or the equity factors that we talked about. So rather than having, you know, we might have half to a third of the number of factors available on those companies compared to a company which is listed, and we've got very deep and lots of data across the whole range of factors that we look at. So it's key in the selection and analysis process of those factors that you can take that into account. Because as I touched on ESG, if you just lose that part of the universe and you just don't create factors for companies that don't have listed equities, you reduce your opportunity set and the companies that you can invest in dramatically, and therefore you're going to reduce the alpha or return that you can generate from the model. So in our process, we have ways to consider that and make sure that we produce a factor score for every company, no matter whether it's got, you know, a score for every single factor or it's only got data for a smaller percentage of the factors.
Excellent. Well, at this stage, we would like to thank obviously the CFA Society in the Netherlands and everybody who's dialed in today for this deep dive into Fidelity proprietary sustainable multi-factor model. And I would like to pass the channel back to our host.